Oh, hi everyone. My name is Kunle and I am your insurance broker. Uh, Happy Sunday and hope we all had a wonderful time in the presence of God. Though it was online, I had a very wonderful time and I just, there's this thought that has been coming to my mind since the beginning of this pandemic crisis, the coronavirus issue. I've been thinking, is it good to discuss insurance at this very time? Many have said no, insurance is not a good buy at this time. But I then came about this little video that made me understand even the need of insurance in this time. Now, when we talk about insurance, many think it's a case of maybe putting a curse on you that you have to die. No, I emphasize no. Insurance basically is keeping the financial worth of a particular family, property, or whatever it is. Now, insurance is not going to stop what would happen from happening, but insurance is going to bring back to status quo what is or what used to be. Now, as a breadwinner of my family, I have a standard that I must have set for my family. Now, what if I go out today and I don't return home? What if rain falls in the next 5 minutes? What if death occurs? Now, this is the part many don't like to hear about insurance, but that is actually what insurance is about: safeguarding the financial worth, the labor that you have been through all these years. Some have their all they've done over the years crumble in just a split second. Now, insurance is there to make sure this doesn't happen to an individual. Now, to buttress my point, I'm here to just put a light, enlighten us about the flexible endowment plan. That's FEP from AIICO Insurance. Now, flexible endowment plan is an endowment plan, as the name implies, that holds security and investment. Now, security in the aspect of what if death occurs? What if I go out today and don't return to my family? Would they still maintain the status quo? That is, would they still maintain that life that I have given to them over the years? Now, the question is, when a breadwinner dies, what happens? Number one, the children become fatherless. Two, the spouse becomes a widow or a widower, as the case may be. And three, the spouse is left to bear the burden of the finance of the family. Now, this is where insurance comes in. Now, the security of the family is the priority of insurance companies. We have situations of a family losing the breadwinner and the family having to leave the position they were before. Possibly they live in Lekki, phase 1. They now have to move as far as Abeokuta just to maintain the little life that the spouse can afford. The kids would have to leave the school they were before, and this is as a result of lack of planning in the case of the barest risk you can have. Now, that is the security aspect of the flexible endowment plan. Now, the investment aspect, which is a very attractive one, is that while you pay premiums, we do not wait till death occurs or till maturity of the plan before you get you start receiving a tangible sum from your investment. For every 1/3 of the duration of this plan, there is always a payout of 25% of the sum assured you must have proposed. Sum assured basically means a particular amount that if anything happens to me, pay my family outright this amount. Because if you're filling out forms, you have the beneficiaries quote. You fill out your beneficiaries and the percentage you want the value to be in. Now, this sum assured is actually what is called the proposed amount you must have valued yourself or the risk to be, that in case of any happenstance, pay my family this amount. Now, the sum assured for every 1/3 of the duration, I put, for instance, a 15 years plan, there is a payout of 25% of the sum assured every 5 years of the 15 years plan. That's on the 5th year you get 25% of the sum assured. On the 10th year you get 25% of the sum assured. Then on the 15th year, to bring to your surprise, you don't get 25%, neither do you get 50%. You get 100% of the sum assured. Now put that into writing. You're going to see what that is. Now we don't leave it at that. There is a reversionary bonus of 4% of that sum assured, payable yearly, but would not be paid to you, but put into a treasury against maturity of the plan or early death. Nobody's praying for death. We are going to live, but the priority is, this is more of an investment than, yes, the security aspect will leave it that in case, let's leave that aside, but the investment on it, we have valued over time and seen that it's more over 180% of your investment over time, not considering this security aspect. Now, there is also access to loans of over 70% of the cash value that you must have in your account after paying premiums of over 3 years. What this means is that you can access up to 70% of the cash value you have in your account as loans, and the interest on these loans is 1% per month and 12% yearly if you choose to be. Now the question would be, what if I default in the payment of the loans? Now, if you default in payment of loans, we do not come after you. What happens instead is we wait for your first partial maturity or second partial maturity, as the case may be. Now, if it's the case of your first maturity, as the case may be. Now, if it's the case of your first partial maturity, the default on loans will then be pulled out of the partial maturity. Now, this is where I'm going to stop for today, but I want you to know that you can also go online, check www.aiicoplc.com to view more about the flexible endowment plan. And I have a secret I would love to share with you. I really will relish the opportunity to be your relationship manager. Thank you for listening. My name is Kunle Aresa, and you can also reach me via WhatsApp or call on 080-3479-6936. Thank you.